the crucial thing from an actuarial perspective is having an M&A team that has a kind of a mixture of both people who know the business and the market really well, and also M&A specialists who know how these processes work.
You're listening to Rethinking Insurance, a podcast series from WTW where we discuss the issues facing P&C, life, and composite insurers around the globe, as well as exploring the latest tools, techniques, and innovations that will help you rethink insurance.
Hello and welcome to a special Middle East edition of Rethinking Insurance. I'm your host, Matt Facey, and today I'm delighted to be joined by my guests, Roshail Khalid. Roshail is a senior life consultant in our Dublin office who recently joined us from the UAE. And Darragh McHugh, he's a director in a UK and Ireland ICT division, and he's an M&A proposition leader for EMEA. Roshail and Darragh are experts in M&As and structuring deals not only in the Middle East, but globally. So welcome to you both.
Thanks, Matt. Looking forward to discussion today.
Thank you, Matt.
Cool. So in today's episode, we're going to explore what is happening in the Middle East market in terms of M&As and what that means for insurers operating in the region. M&As are somewhat complex and has wide-reaching implications for insurers' people, processes, systems, and data. At the same time, it presents unparalleled opportunities for companies to start afresh, to gain insight into their own business, and to drive growth that will deliver both decision-making, free up capital, and deliver opportunities in markets not known about yet, and also allow them to focus on more value-add opportunities. It also helps underpin the long-term business and success of their companies. But before we get into that discussion, first let's find out a little bit about our guests. So what I try and do is just throw out a random question to you both. So Roshail, tell me what your favorite book is. And if that's too difficult, tell me what your 3 favorite films are.
Thank you, Matt. Yeah, it is a bit difficult question because I'm not into reading book as such, so which is not something to be proud of. But yeah, on the movies, I think I can comment on it better. So the 3 best movies that I've watched so far, the topmost would be the Shawshank Redemption. The second one would be the Green Mile. These are all old movies. And the third one would be the Schindler's List. All these movies are classic. Like, they're really good. These are the movies with a brilliant mix of emotions and drama. Not something with extreme thrill, nothing to action about it. But yeah, overall, these movies are really nice. They keep you engaged throughout. Thanks.
Very good. Good choices. I like all those 3. Darragh, same question to you. Maybe a book or your 3 favorite films.
I think it'd be hard to follow Roshail's picks for films, so maybe I'll stick to the book then. I think maybe All Quiet on the Western Front, which was actually recently made into I think it's been made into a film a couple of times, and there's a new one out on Netflix. But it's it's a very good book. One of my favorites.
Perfect. So going from All Quiet on the Western Front to the Middle East. So I'm just going to get started with some specific M&A questions, really, to get you warmed up, and then we're going to delve into the M&A market within in the GCC and the Middle East specifically. So I guess, Darragh, just first question to you, like how would I know when is a good time to sell my business?
Yeah, no, it's there's probably a couple of indicators. It's a good question. I suppose one of the first ones, and it's maybe a little bit of an obvious one, is, when the regulator taps you on the shoulder and tells you that you have to. Obviously, you don't hope that you'll end up in that scenario, but of course we have seen a lot of companies impacted by extreme events over the past number of years, and indeed even recently, whether it be COVID or extreme market movements, and those that may be just struggling with solvency cover and with scale, being prompted then by a regulator to look for a sale or a merger. And this is something that we've seen in quite a few of the Middle East markets. It's a tricky situation too, as it may limit your kind of prospective buyers, and the buyers that are there, they'll know that there may be issues and there may be a time limit as well imposed on it all. So maybe stepping away then from that sort of maybe more direct reason, some of the other ones then, one that we've seen a lot of activity driven by is, parent companies maybe refocusing their strategy on particular markets or particular lines of business. So if you're a company that you want to focus on, for example, P&C insurance, and you have a life entity, you may decide then it's a good time for you to divest of, say, capital intensive life business, and refocus then on your P&C book. Sometimes this is driven by internal analysis, but as well, we've seen external investor pressure on management also to dispose of non-core businesses. This has driven a lot of activity globally. For example, a good example would be Aviva, that has divested from a number of geographies over the last couple of years to refocus on their core business. So if you are, not seeing returns from a certain geography or line of business and are struggling maybe to establish market share, then M&A could be a useful tool for you. And then opportunistically, I mean, the appetite there has been very high from buyers. If you're considering divesting, and you see similar deals happening in the market, it may, given the level of demand that's there, may be a good time for you to, cash in on a less core asset, if the pricing in the market is good, and keeping an eye on the market and the price is achieved then by other transactions should be an important thing that all senior management functions are looking at.
Perfect. Yeah. I guess just talking about the value and the cost to the business, then if I throw a question out to you, Roshail, like how would I find out the value of my business at that point?
So I wouldn't go into very much technical details, but the most commonly used approaches that quite a few players in the market use are embedded value and appraisal values. So embedded value is usually used where the business is a runoff. And if there's an expectation of good amount of new business in the future, then appraisal value approaches are quite common. We have seen quite a few variants becoming popular. Market consistent embedded value is one of those. In European markets, we have seen operating capital generation approach as well. So in this approach, it's on a real world basis, where the company look at the release of capital and the margin in the business, and ultimately these margin and release in capital drives the remittance to the shareholders. So it's ultimately, if you talk about these approaches, most of them are about the future dividends or the payouts to the shareholders. The value of those dividends are calculated in terms of the present value. And sometimes the value of intangibles is undermined during the valuation process. So there are quite a few methods of valuing the intangible, like goodwill and patents, which we have been working on in Wilshire Watson in the past. So we have got a few experts our team of experts who have a special focus on the tangible as well as intangibles.
Yeah, that's right, Roshail. And maybe if I just jump in there, of course, there's formal ways of valuing business, whether it be embedded value or that operating capital generation that Roshail spoke about. But obviously, a key thing too, as well, is around the level of interest and the competitive tension that a live process can bring. So I suppose having advisors that know the market, know the level of interest in there, and know the sort of multiples of embedded value that are being achieved as well can help you to, I guess, establish a range then around what might be a derived embedded value before you maybe make a decision whether to go to market with an asset.
When you talk about the assets and the embedded value, then like how can a company ensure the top value for their business?
Yeah, I mean, I think it's nearly the first question on everyone's minds when an M&A is kicking off, is making sure that that the deal maximizes the value for the shareholder, of course. So look, I mean, where there's capacity to do so, having a sort of preparatory phase where before the process that can certainly pay dividends. So we've worked with quite a few clients that are targeting a sale, and have maybe gone through this type of process where they're implementing different actions. Some in the short, some might only take a short period of time. Some actually can take place over many years. Some of these might include things like, implementing an outsourcing arrangement, reducing your expenses, reducing headcount, reinsurance, some liability management program, basically some ways to try and clean up the business and, make it as attractive as possible to a buyer. Even if you don't do that preparatory phase, even if you're just going straight to sale, one thing that we always say whenever we're working with buyers is, it's critical to have a well-designed information pack for bidders, and a well-established virtual data room or VDR. We've worked with a lot of buyers of insurance business across the globe. So from doing that work, then we know exactly what it is that they're looking for. So then when we're on the sell side, what we try to do is we design then an information pack that allows those bidders to essentially take the material that's provided and plug it into their own deal pricing models. Obviously, they need to do their own due diligence, as well. But what this tries to do then is to sort of reduce that uncertainty for the buyer, and ultimately then reduce or eliminate any potential haircuts that they might be applying in respect of uncertainty on the value, and therefore give increase the value for you as the seller. So they're probably the two of the main things then that I would outline. So that preparatory phase, and then having a really well designed information pack for the buyer.
The other thing I had in probably my mind is the type of team that you would then bring to the table. So what type of, I guess it's how long's a piece of string, but what type of M&A team would I need if I'm selling my business?
Yeah, I mean, again, this can kind of vary on deal size. But I mean, for example, typically an investment bank, actuarial advice, legal, tax, HR, you may need advisors across all of those. Obviously, I'm coming from an actuarial background, and the crucial thing from an actuarial perspective is having an M&A team that has a kind of a mixture of both people who know the business and the market really well, and also M&A specialists who know how these processes work, know how to interface with bidders, know how to build those types of relationships. What that really brings you then is you've got people who understand the business really well, but also understand the process too. I think too, having independence is something that's often appreciated as well by clients. So typically when we're working on a deal, we generally work one side of the deal, so either sell side or buy side. And then too, of course, having an internal team as well, having the right people brought into the circle early on in a process, I think is crucial, because once these processes start, they can be quite intense. There's a lot of Q&A, a lot of back and forth. So having the right people from your business involved and able to support, I think, is a crucial part of ensuring a successful process.
Yeah, that sounds super interesting, actually, and quite difficult. But again, another how long's a piece of string question. But how long would it normally take to sell my book of business or to buy a book of business, I guess?
Yeah, I feel like we're giving a lot of answers here that are it depends, but of course it does depend. It depends on a lot of things, where complexity, all the rest. I mean, if I was to set aside that preparatory phase that I spoke about earlier, and I'd say, a relatively clean process, I think it probably takes in the order of maybe 6 to 9 months. Maybe just to break that down a little bit further, you could be talking maybe when you have that initial kickoff call, maybe 3 or 4 months then, where you're getting all the material prepared, the actuaries are preparing a appraisal report, you're putting together a data room, you're putting together an information memorandum. So once that 3 or 4 months are up and you're ready to go live and the data room opens, you're then talking maybe between another 3 to 5 months of a live process with the data room open, Q&A back and forth with bidders and expert sessions and management meetings. And then at the end of that process, you getting a binding offer and then working towards closing. So I think probably from that initial kickoff meeting to getting the binding offers in 6 to 9 months for something that's relatively clean. But again, I've seen things go on longer where there may be more complexities or issues involved with the process.
I guess just to give you a rest there, Darragh, I guess, Roshail, just the next question to you is how would I ensure that all my employees are taken care of during the acquisition?
So I think this question has 2 parts. I would like to split it in 2 parts. So first would be taking care of the employees during the M&A process. And the second would be taking care of the employees or ensuring that the employees are employed after the M&A process. So during the process, the merger and acquisitions are usually treated as confidential projects, as you already know. Only a few employees are usually involved, and company would be relying mainly on these employees for the calculations of whatever work is involved. So and that's on top of their BAU. So business as usual. So we usually see quite a few people stressed out during the M&A process. And this results in bottlenecks and stressful work conditions as well. So for large players, we have seen that they usually have their in-house M&A experts, which are responsible for the work. So it's not that big of an issue for large players. However, for a small or medium-sized company where there are no M&A experts, I think one way is to get an external expertise, something like a consultant maybe on accounting or actuarial side. So that would help the employees ease off a bit, and it would give them space to focus on the BAU as such. And moving on to the post M&A process. So you must have seen that at many times employees leave the organization as soon as they hear about the acquisition, let it be portfolio transfer, merger, or the change in ownership of the company. So sometimes they're actually laid off, but sometimes it's just the uncertainty or the resistance to change when the ownership changes, because the feeling is that the management would change and ultimately they would be laid off, but that's not always the case. So we have seen that regulators are often very concerned about the employees. And sometimes, for example, when I talk about UAE, since I've worked there in UAE, as per my knowledge, the central bank of UAE often asks questions about what will happen to the employees after the ownership of the company changes or the M&A happens, or for example, the portfolio is transferred. So the companies are answerable to the regulator. So we have seen some agreements between the companies, like the buyer and the seller both agree that the management of the company would stay and would not be laid off. And sometimes there are no agreements, but still we have seen that quite a few companies do not actually lay off the employees even after acquiring another company, for example. And you must be aware of a recent huge acquisition between GCC and GIG and AXA, where no massive layoffs were seen as such. So whosoever left the company is usually mainly because of the uncertainty, but there were no massive layoffs in the market as such when that happened. So yeah, it's a combination of efforts from the regulator and the companies themselves to take care of the employees.
So again, you touched on a couple of companies there and a couple of regions actually. So when I log on every morning and I get my Middle East Insurance Review email, there's a heck of a lot of activity in the M&A Middle East market. So just from your point of view, Roshail, why do you think there is so much activity in the Middle East and the M&A market at the minute? I don't know if you just want to touch on a couple of the the main countries first.
Yeah, sure. In UAE, yes, you're right. There have been quite a few M&As and portfolio transfers in the past, and quite recently as well. So if you see UAE, it's a very small market, right? But if you see the companies operating in the market, there are more than 60 companies which were operating in 2021, which is a lot in numbers when it comes to considering such a small market. And interesting point is that around 20 companies out of those 60 were insolvent, and they were badly insolvent. They were struggling. Now there's a massive price pressure. The margin are shrinking for the companies. The profits are reducing, especially for these small players. So the solvency is not expected to get better anytime soon. So what we have seen is the regulator is pushing these companies a lot to improve their solvency margins, right? The shareholders do not want to invest or inject capital because the companies are not making profit. So ultimately, the companies are moving towards M&A because there's a massive pressure from the regulator to fix the solvency position of the companies. This is the first major factor I've seen. The second one would be like I've seen quite a few international players who had the branches in Middle East have exited the market. And in order to exit the market, you have to transfer the portfolio to the local players. So that is what they have done. Recently, like quite a few, like 3 or 4 in the last 1 year, I've seen companies exiting, 1 or 2 years, I would say. And if you see the situation in Saudi, the Kingdom of Saudi Arabia, it's quite similar in terms of the regulatory pressure. It's exactly the same case. Quite a few small companies are operating. Regulator does not want many small companies, but a few large ones with solvency strength. So, but one thing that I feel is different in Saudi is that the regulator is actually incentivizing the consolidation of the companies by reducing the regulatory fee, for example. This is what I've heard from quite a few people around in the insurance market. So yes, both of these countries are actually going through many M&As, and especially in UAE, we are expecting a few more in the near future. Over to you, Darragh.
Yeah, no, maybe just to talk a bit more generally. I mean, there's one big one at the minute, of course, is even just from a capacity point of view and team capacity. I mean, a lot of the teams that are involved in M&As, the actuarial teams, have a lot on their plate at the minute with IFRS 17 and other stuff. So we've certainly seen that as being a challenging aspect to M&A processes as well. I mean, more technically, then I guess one of the major things is trying to, I suppose, understand complex business in a short time frame. That's what we hear from buyers all the time. Whether it be P&C, life business, in Europe or the Middle East, is trying to get to terms with complex liabilities, understanding policyholder options, understanding how market movements may impact those options, and trying to do that in a relatively short time frame, where you have it maybe a 6 or 8 week process. So that's obviously a big challenge for people. It's not insurmountable. It's where we tend to spend a lot of our time helping clients when we're in these processes.
Very cool. I think just as a final question to you both, because everything in the world these days is done in threes. So what are your top 3 things a CEO should consider when they're thinking about a potential M&A? So from a buy side and also from a sell side. So maybe Roshail, if you take the buy side of things and then Darragh take the sell side.
I think the first thing that CEO should consider is whether the company has an expertise on valuing the business, because it's quite a complex process, and some of the companies may not have the right expertise. So it's very important to have a proper expertise both on the accounting, legal, and actuarial side, so that an accurate, unbiased value of the company is determined. Second thing that the CEO should consider is the nature of business that has been written in the past. So it's especially relevant to long-term life business. So I have seen like quite a few companies writing endowment policies with very high amount of guarantees in the past in Middle East market. And now the companies are struggling due to the low interest rate in the market. They are not able to fund the guarantees as such. So these companies are like their main objective is to get rid of the portfolio now. So CEOs should be careful about not getting such portfolios because it's loss making. And the third thing I think that should be considered by the CEO is whether the integration or merger would bring economies of scale to the companies or not. Because sometimes when you talk about two different companies merging together, it's not that easy to integrate, and sometimes the current administration processes that the company has may not be leveraged for the new products, for example, which they are acquiring. So rather than cost savings, it becomes quite cost incentive for the company to merge the portfolios into, for example, one administration system. Yeah, I think these are the three main factors that I think CEO should consider.
Maybe then if I'll jump in there on the sell side. So look, I mean, I think there's certainly overlap as well with the buy side. Often, similar things need to be considered. But if I was to maybe pick the top three then for the sell side, I'd probably go with your team, the buyers, and the price. Okay. So, I mean, we've spoken at length now about the team, both internal and external, making sure you have the right people involved and the right people involved early. Maybe just to focus on the other two, so the bidders and the pricing. I mean, obviously, it's extremely important for you to know what the value levers are in the business and what sort of pricing that you should be targeting, and really understanding as well when the bids come in, how they are reflecting those value levers in their offer, so that if there are areas then that you can challenge, that you're well equipped to do so. And then as well, what's crucial really is having the right bidders involved. It's often good to have a number of bidders involved, so you have that little bit of competitive tension there from a pricing perspective. But as well, it's critically important that you have execution certainty when you're running a deal. I mean, M&A processes they're not cheap. You have to they do cost a lot in terms of both people power and also just pure cost. So what you don't want to happen is that you arrive at the end of a process with a bidder who's then unable to execute because, for example, the regulator won't give them the authorization or something like that. So you do want a mix of to make sure that you've got bidders that are involved to give you that competitive tension, but also that are credible and can provide you with execution certainty as well.
Cool. Yeah, very good. Yeah, it's a complicated recipe, isn't it? Really, the M&A market, especially in the Middle East and further afield. I guess what I'm hearing from both of you is that when you are going into the M&A world, is there a market or opportunity that makes this acquisition essential? Is it a compelling target? What is the size of the market, and does it fit with your current growth strategy? And to what level can the business be grown? That's a big question, I guess, when you're buying a company. And we do have to think about the people side of things, and what would your customers and competitors say to this business, merging? But it's all very, very interesting, and I think the market in the Middle East is hotting up. There are a lot more M&As happening, and this is something that is very interesting and can really help companies in the future. Just wanted to say a big thank you to you, Roshail, and to you, Darragh, for spending the time and talking with me today. And we'll speak again soon on Rethinking Podcast. Thanks both.
Thanks.
Thank you, Matt. It was a pleasure. Thank you.
Thank you for joining us for this WTW podcast featuring the latest perspectives on the intersection of people, capital, and risk. For more information, visit the Insights section of WTWCO.com.